All right, first thing I'm going to show you is how to calculate your own debt to income ratio. DTI. If you hear that, that means debt to income. And the lenders and the banks, when they do refinances, when you buy a house, they're very interested in this number. I want you to burn this number into your head. 45%. That's your maximum debt to income ratio, okay? Anything above that is nuclear, toxic, radioactive, okay? So you always want to keep your debt to income ratio well below 45%. Here's how you determine what your debt to income ratio is. You look at all the debt that you have on your credit report. I'm not talking about your phone bill or your cable. I'm talking about things that are reported onto your credit report. Real estate, mortgages, your car payments, your installment payments, boat payments, your credit card payments, your minimum monthly payments, your student loans, any kind of child support that would show up on there, anything like that. You add all those things up. If you own real estate, you also have to add in the taxes and the insurance if they're not escrowed into the payment. So let's say all that is $2,800 every single month, and then you look at your income, and let's say your qualified income that the bank's going to consider qualified income is $10,000 a month. You basically just divide your debt by your income. So this individual would have a 28% debt to income ratio. Okay? Now, how do you determine how much money you can borrow basically from this? So you can borrow the difference between 28 and 45%. So I'm going to show you what's called a reverse debt to income ratio. You're basically just going to take your income, 10,000 bucks every month. You're basically going to take 45% of that. That's $4,500. That's your maximum debt to income ratio. You're going to minus your existing debt out of that, $2,800. That's going to leave you $1,700 bucks in room until you hit 45%. I use an easy 1% rule because typically your mortgage payment is going to be about 1% of the loan amount. Okay? So that means if you have $1,700 bucks a month you can spend before you hit your 45% debt to income ratio, that means most lenders are going to lend you $170,000. You've basically just done your own pre-approval letter.